White and I'm a Senior Associate in DLA Piper's Litigation and Regulatory team based in our Abu Dhabi office. As part of our Middle East vlog series, I'm going to be talking about a couple of interesting developments in the UAE free zone of the Abu Dhabi Global Market, or ADGM. In particular, I'm going to be talking about a couple of recent actions of the Financial Services Regulatory Authority, or FSRA. So the first development I'm going to be talking about is the FSRA's first ever imposition of a fine for AML breaches, which was issued in August on Wise, previously known as TransferWise, the money services provider. So to give a bit of context, in March 2022, the UAE was put on the Financial Action Task Force grey list, meaning that the Financial Action Task Force had identified deficiencies in the UAE's money laundering, anti-money laundering and CFT controls. The reason given was the UAE's apparent lax enforcement against money laundering. So one of the issues in the UAE's action plan is to demonstrate an increase in effective investigations and prosecutions of money laundering cases consistent with the UAE's risk profile. Now, in terms of the Wise fine, the FSRA found that Wise had failed to implement sufficient money laundering controls over a 2-year period. And there were several failures listed in the final notice. Firstly, Wise had failed to verify a customer's source of funds and source of wealth before carrying out their transactions. Wise had instead only carried out source of funds and source of wealth checks once certain thresholds were surpassed in respect of particular customers' accounts. And this was also only after a business relationship had been established. Secondly, Wise had failed to ensure that senior management were consulted with before business was established with high-risk customers, which is a key requirement of the AML rules. In addition, Wise didn't consider customers' nationality when assessing them for risk, as required by the AML rules. And this was something that Wise had been warned about by the FSRA previously, and they'd actually promised that they would remediate the issue, but had still failed to do so. And finally, Wise didn't obtain and consider adequate information on the intended nature of business in respect of a category of customers before establishing a relationship with the customer. So in terms of mitigation, it was quite important that the FSRA didn't actually find any concrete instances of Wise having enabled money laundering. And in addition, Wise plus its senior management were fully cooperative with the FSRA and took steps to remediate the FSRA's issues pretty quickly. The failures were also in part mitigated by Wise's setup, which only allows customers to fund transactions through bank transactions rather than through an independent account balance via Wise. In addition, Wise didn't dispute the FSRA's findings, and it also agreed to settle at the earliest opportunity. This meant that it was able to qualify for a reduction in the financial penalty of 20%. So the ultimate fine that was payable was relatively small. It was only $360,000 US. Now, in terms of other key takeaways, in respect of outsourcing, the FSRA was fine in principle with enhanced due diligence on high-risk customers being outsourced within the broader Wise group. But this was provided that such outsourcing was done to a properly qualified individual or committee, whereas Wise had failed to ensure that there was sufficient governance over the process. In addition, if you are using thresholds, so Wise used thresholds for initiating enhanced due diligence, which the FSRA said were too high for the particular customers. So the FSRA doesn't say that you can't use thresholds, but make sure the thresholds you use are realistic and that they reflect the usual transaction amount for the customer. Mitigation. Aim to cooperate and remediate. Where failures are identified, a fast acknowledgement and remediation will influence the way the FSRA deals with you. By the time the final notice was published, Wise had corrected the identified wrongs and had even stopped taking on new customers whilst it was remediating. Now, whilst the wise decision and the fine isn't significant in terms of a pure financial value, it's clear that UAE's regulators will be trying to get the UAE off the grey list, with an increase in investigations and prosecutions surely to ensue. It's in this context that the wise fine may well be the first of many further enforcement actions by the FSRA. And so if you are an ADGM company, it may well be worth having your compliance with the AML rules stress tested independently. Finally, I just wanted to touch upon another interesting development by the FSRA, which is its publication of the guiding principles on its approach to virtual asset regulation and supervision. The guiding principles are not binding, but they complement the published framework and highlight the FSRA's principles, which are a robust and transparent risk-based regulatory framework, high standards of authorization, preventing money laundering and other financial crime, risk-sensitive supervision, commitment to enforce on regulatory breaches, and international cooperation. Now, it's significant because this marks another step in the FSRA asserting itself as a pioneer in this area. It created the world's first bespoke comprehensive regulatory framework for virtual assets in 2018. So it's going to be interesting to see whether these developments will in time result in the ADGM's establishment as the key jurisdiction for virtual assets, and also an increased market confidence in the integrity of the asset class as a whole. For more insights from our litigation and regulatory team, please join us at our Middle East Disputes Client Conference on Thursday, the 26th of January 2023. You can find more information about the programme and how to register by clicking on the link on screen now. Thank you.